Welcome back to the budget special coverage. Well, as we told you, first up, we must get the macros right. So what are we expecting in terms of policies? Jahangir Aziz, Head Emerging Markets Economic Research at JP Morgan, and Sonal Verma, Managing Director and Chief India Economist at Nomura India, join in. Good morning, both of you. Jahangir, first to you. What will be your reaction if there is a large farm package of, say 2 lakh crore rupees?
So clearly, it will stretch, the revenue side of the central government budget. It will force the central, if let's say a large farm package is announced, and we do expect that large farm package to be actually implemented in the current fiscal, in that fiscal year, and then it will likely stretch, the revenue side of the budget, not just of the central government, but also the state government. It will push the borrowing, whichever way accounting, changes that they make, to the public sector. Food Corporation of India goes again and starts borrowing from the thing, which is why I think as an investor, I think what people should be looking at, and people are increasingly looking at it, is the overall size of public sector borrowing, because that essentially is going to affect bond yields. It is also going to tell you how much money or how much resources is left for the private sector. And that's what will determine the bond yields. I don't really think that people are going to obsess, look at the central government's budget deficit number and say, oh, everything is fine. But the announcement effect has an impact. I mean, let's not kid ourselves. If there is a significant amount of concern in the market that this year's budget outturn will be much higher than 3.3. Next year's budget will be a much larger expansionary number, and I don't think you are going to get those numbers. You will get numbers which are close to 3.3 for this year's outturn. And you will get a number which is probably about 3.1, 3.2 for next year's budget. So I think the worries will come. People will start pouring into the details, raise questions about the credibility of numbers. All of that will happen. But my sense is that we will wait and see what happens when the new government comes in power in July. And most likely, most of the borrowing will be in the second half of the year, not in the first half of the year. RBI will make sure that the first half of the year borrowing is lighter. So.
Okay, I take your point that, you'll have to look at how credibly the entire package is provided for. But, yeah, as you said, the market only worries about how much the government will borrow. Suppose the borrowing number, the fiscal deficit number, is, say, 6.8 trillion, 6.8 lakh crore. Is that okay? Kosher for the market? Bond market's happy?
Look, I think the bond market should be worried. The bond market is worried. And I think it is increasingly that the bond market is actually looking at a larger definition of what is public sector borrowing. I think if you look at public sector borrowing, and if you just include the center, the state, and just the central public sector, I'm not even including the state-run public sector, we estimate it was about 8.2% of GDP in the last fiscal. It is going to be around 8.2, 8.3% of GDP in this fiscal year. It is most likely going to be something slightly larger in the next fiscal year. If you add to that, state government public sector enterprises, about which we have very little data, we have already touched a 10% of GDP mark, and close to that in 2019-20. So the bond market should be worried. But more than the bond market worrying about yields, etc., I think the real worry is that you have a current account deficit of about 2-3%, right, for India as a whole. 10% is coming from the public sector, which means that the private sector in India is running an equivalent of a current account surplus of 8%, i.e. their savings is 8% higher than investment, and that can only happen if investment is really languishing. I don't see evidence that the saving rate in India has gone up. Corporate savings clearly has come down. Household savings barely holding its place. So it must be the case that despite what the CSO numbers show, investment must be taking a very large hit.
Okay, that point is taken. Jahangir, just stay on. We have Sonal Verma, the MD and Chief India Economist at Nomura, who also joins in. Sonal, hi, good morning. Big day here. But what's your own expectations? If there is a 2 lakh crore package, and more importantly, if it is a recurring liability, do you think that won't go down well with the street?
I think in terms of the headline expectations, something like a 2 lakh, which is about 1% of GDP, clearly would be much higher than expected. And I think the headline message that clearly will go out to investors is that the government is prioritizing, so to speak, populism over fiscal prudence. Now, beyond the headline, I think, the impact and the view needs to be a lot more nuanced because, whether the package is, like you said, one time or it's a recurring one, is something that one needs to consider, because if it's a one time, the impact may not be as much as the impact of a recurring package. Second, in terms of, whether whether a cash transfer is being replaced by some of the existing subsidies or schemes or not, and therefore, what is the effective net cash outflow that's happening on account of the package is very important to understand. Third, in terms of whether there's a distribution of this cost between the center and the state. So I think, the headline message, of course, is going to, if what you're saying is true, then the headline message clearly is going to be negative. But the impact, I think one needs to assess based on sort of a more nuanced view. But I think overall, what it would suggest is that over the next 12 months, we should be expecting crowding out of investments and more of a consumption-driven recovery in India.
Well, Sonal, do you think bond market will fret so much? Because after about 12 months, you will realize that your GDP actually grew at 8% or at 9%. So really, your fiscal deficit on hindsight would have been achieved. How much will the bond market really worry about, 11.3 or 11.5% GDP is assumed, and therefore 3.2% of that, when all the numbers change in 12 months?
Lata, I mean, that is something that clearly fogs sort of the macro dashboard. And therefore, the assessment of where the macroeconomy is, whether it's on inflation, where we've seen spikes in, specific rural categories, or these sudden jumps in the GDP growth rates, I think that's a sort of a separate issue that clearly, but is important, because I think as anybody who's assessing where the economy stands right now, it's important to take a more broad-based assessment rather than based on just the official statistics. But I think, how credible the assumptions are on taxes, on disinvestment, the accounting on the expenditure side is something that the markets will clearly look at beyond just the headline fiscal deficit number. So these nuances will matter. And I do think, the signaling and the total size of the government does, and the stance that it takes on how it is, how it thinks it needs to really respond to the current farm distress.
Okay, finally, what are you going to tell your clients at the end of the budget, Sonal? Let us assume that it is going to be a 3.3 or a 3.2% fiscal deficit, an assumption of a 6.5 lakh crore government borrowing program. Those are the two big numbers that will determine the cost of capital. And let us assume it's going to be a 14% revenue growth and a 10% expenditure growth, which is what is normally assumed. If you get this, what are you going to tell your clients? Will you tell them that Indian cost of capital will rise? Or do you think it will fall, actually, because the RBI is anyway there to do OMOs?
So, Lata, if we do get a farm package and a fiscal deficit for next year, which, is marginally lower, let's say at 3.2 vis-a-vis 3.3 this year, then I think the message clearly that the government is trying to give is that, yes, the farm sector is important. This is what we are doing. But at the same time, we are not going to do this at the cost of completely derailing the fiscal prudence, which we've tried to adhere to. So I think the fundamental message here would be, and that one should take, is that there's a balance of prudence and populism that the government is trying to achieve. Now, the risk that we see, and that signaling is positive, I think, clearly, because expectations are that it's going to be very populist, there'll be fiscal slippage, etc. But the key going forward and the key risk we see in the next 12 months is really that the growth outlook globally and in India is looking a lot more shaky. And therefore, the assumptions that go into the budget today, will be stressed in terms of particularly the tax buoyancy assumptions that are made. So the actual consolidation may not be as easy as is assumed in the budget right now. But broadly, I think the next budget that will come out in June, July, then will become quite important. Will the cost of capital go up? I think if we are in a slowdown mode for the private sector, which is what we expect, then the aggregate demand for funding may not rise as much. So the cost of capital may not increase as much. But clearly, the fact that size of the public sector borrowing is quite large is a fact. And as we see the private sector kick in terms of demand, public sector needs to step out. That would be the main takeaway.
Okay, Sonal, thanks a lot for joining us. We'll have to end this discussion on that note. Exactly 3 hours left and we'll know what's on the Finance Minister's mind. But don't go anywhere. On the other side of the break, Arvind Sanger of Geosphere Capital Management and Teresa Baja of Kartika Management will be with us to give us the FII wish list. Stay tuned.